You know that feeling in your gut when you see the stock market tanking? It's scary, right? But it's also just part of the game. It's inevitable. But what if I told you it doesn't have to be a bad thing? In fact, what if it's the best thing for your wallet? Today, we're going to break down a playbook that shows you how to turn all that chaos into a massive opportunity to build real wealth. So, let's be honest. When the market starts to fall off a cliff, what's your first reaction? For most people, it's pure panic. You see all that red and your gut just screams, "Get out, run for the hills." But what if we just flipped that script? What if we stopped seeing a crash as this random disaster and started seeing it for what it is, a totally predictable part of the cycle? And here's the kicker. If you know it's coming, you can get ready to use it to your absolute advantage. And listen, this isn't just some feel-good theory. It's about choosing your approach. Are you going to be the person on a flimsy little raft, just getting tossed around by the waves, totally at the mercy of the storm? Or are you going to be the captain of a solid ship who saw the storm coming and prepared for it? Seriously, the big lesson from investors who've been through this stuff for decades is that with the right prep, you can actually come out of a crash wealthier than you went in. So let's stop fearing the storm and start building our ship. Okay, so before we can prepare, we got to know what we're preparing for, right? Let's break down the lingo. First up, you've got a correction. This is a drop of 10% or more, and honestly, it's super common. Happens about once a year, give or take. Then you've got a bear market. This is a bit more serious, a drop of 20% or more, and you can expect to see one of these every 4 or 5 years on average. And then there's the big one, a collapse, a drop of over 30%. Thankfully, these are really rare. Now, this is where you really need to zoom out and get some perspective. Just look at this comparison. The average bear market, when everything's going down, lasts about 9.5 months. Feels like forever when you're in it, right? But now look at the average bull market when things are going up. That lasts on average 2.6 years. It's not even close. It's such a great reminder that the good times last way, way longer than the bad. These downturns, they're really just bumps in the road on a long-term upward journey. So, the big question is, how do you actually prepare? Well, it all starts in what we'll call phase 1, the euphoria. You know this phase. It's when the market is flying high, everyone feels like a genius, everyone is making a ton of money. And that right there, that blind happiness, that's your biggest warning sign. It's the absolute best time to start preparing for rain, precisely because the sun is shining so brightly. I mean, think back to the whole NFT thing, right? People were dropping millions of dollars on JPEG files, literally. That is a perfect textbook example of euphoria. When you start seeing things that just make absolutely no logical sense, that's your cue. It's a massive sign that there's just way too much easy money floating around, and the whole system is getting dangerously overheated. So what's the play here? It's simple. Be the tortoise, not the hare. This is not the time to get greedy and chase those insane 100x returns you see on social media. Forget that. Your focus should be on locking in reasonable, steady, and consistent gains. We're playing the long game here, the compounding game. And in that game, slow and steady always, always wins the race. So, what does that slow and steady prep actually involve? All right, let's get into your actual pre-crash battle plan. When your spidey senses start tingling, here's what you do. Step 1, start minimizing risk in your portfolio. Dial it back a bit. Step 2, reduce your leverage. That means paying down debt, especially any debt you use to invest. Trust me, the last thing you want is a margin call from your broker at the bottom of the market. That's a guaranteed way to go broke. Step 3, save extra cash, and I mean on top of your regular emergency fund. And finally, step 4, diversify. You've heard it a million times, but don't put all your eggs in one basket. Spread it out. And then it happens. The bubble pops. The market tanks. Welcome to phase 2, the reckoning. This is the part where everyone gets a harsh wake-up call. But here's the thing. This phase isn't really about your investments. It's about your mindset. Everything you did in phase 1, that was all to make sure you could get through this part with a completely clear head. So, I want you to really think about this for a second. Be honest with yourself. The market is down 30%. A third of your portfolio is just gone. What is your very first gut instinct? Is it to hit the panic button and sell everything just to stop the bleeding? It's easy to say you're a long-term investor when everything's green, but this moment, this is the final exam. And really, how you react to that test splits investors into 2 camps. You've got the panic seller on one side. They let fear take over, they sell at a loss, and they lock in that pain. But on the other side, you've got the prepared investor. They don't panic. Why?
Because they stick to the plan. They remember why they invested in the first place, and they don't see a crisis. Nope. They see a sale, a massive, once-in-a-while opportunity to buy amazing assets at a huge discount.
There's this great story from the legendary investor Peter Lynch. He bought stock in a company called Kaiser Industries, and right after he bought it, the price just kept falling and falling and falling. He said he was shocked, but he didn't sell. Why? Because he'd done his homework. He knew the company had zero debt and was fundamentally solid. So he held on. And sure enough, the stock eventually turned around and made him a fortune. The lesson is so simple, but so powerful. If you don't actually understand what you own, you are going to panic when the price drops. So if you're not supposed to be selling, what are you supposed to be doing? You're buying! But look, nobody can time the exact bottom of the market. Don't even try. It's a fool's game. The real strategy here is something called dollar cost averaging. It's simple. You just invest the same amount of money on a regular schedule, like every 2 weeks or every month, no matter what. This naturally makes you buy more when prices are cheap and less when they're expensive. It's brilliant because it completely removes emotion from the picture. And this is why all that prep work in phase 1 was so incredibly important. Because in the middle of a crash, there's one simple truth. Cash is king. That extra pile of cash you tucked away, it's now your superpower. It's what allows you to go on a shopping spree, snapping up incredible assets, stocks, funds, whatever, at a 50% off sale while everyone else is running for the exits. And that buying spree leads us right into the final phase. Phase 3, the Phoenix. Because after the fire, after the reckoning, comes the recovery. The market starts to rise from the ashes. It rebuilds. And almost every single time in history, it soars to brand new all-time highs. If you take away just one thing, let it be this. A bull market almost always follows a bear market. It's a historical fact. Think about every major crash you can name. The dot-com bust, the 2008 financial crisis, the flash crash in 2020. What happened next? A massive, powerful bull market. Those moments of pure chaos and fear, that is exactly where the seeds of your future fortune are planted. Okay, so let's tie this all together into your personal crash survival playbook. These are the key takeaways, the simple strategy you need to not just get through the next one, but to actually come out ahead. All right, let's hit the highlights one more time. First, market drops are normal. They are part of the cycle. Expect them. Second, you have to prepare during the good times, not in the middle of the storm. When everyone else is euphoric, that's your signal to de-risk and stack up cash. Third, when the crash hits, it's all about emotional control. Know what you own, have the guts to hold on, and whatever you do, do not panic sell. And finally, put that cash to work. Consistently buy great stuff when it's on sale throughout the entire downturn. Because let's be crystal clear about this. The next downturn is coming. It's not a question of if, it is only a question of when. So the real question, the only one that matters after all this, is, are you going to be ready to build your fortune?